Hi, everyone. Welcome to another episode of On the Record with your host, Tone Vase. And with me today is a guest. I've spoken with him at several conferences in the past. He's been a guest on the World Crypto Network, first time on my channel, I believe. His name is Simon Dixon. And go ahead and say hi, Simon.
Hey, Tone, thanks for having me on. Good to be on your show for the first time.
Awesome. Thanks, Simon. So, I've known of Simon for a while. I remember when you were back in the days through Max Kaiser and those routes. But I'm going to ask you a few questions. My audience may not be familiar with you much these days. I know that when you were first starting out with your companies, you were trying to create an easier crowdfunding platform for people to, invest smaller amounts of money to kind of decentralize investment, take that away from VCs, and that your company has gone into a slightly different direction, which I will ask you after that. And Bank to the Future, I believe, is still your main company. And tell us a little bit about yourself, how you started, and what is Bank to the Future, and what you are working on these days.
Okay, cool. All right. So, I was in 2006, I left investment banking. I did 2.5 years as a market maker on the London Stock Exchange for AIM alternative investment stocks. And then I was working on IPOs in corporate finance before throwing in the corporate towel. I guess my introduction to Bitcoin is I was doing a lot of stuff on banking reform. I wrote on the subject. I gave a lot of talks on the subject. And I was invited to speak at the first Bitcoin conference in Prague by Amir Taki. And that was on the topic of the difference between Bitcoin and banking. Around 2010 is when we started Bank to the Future. At the time, there was no real word equity crowdfunding. That was something that was created in the UK. And the idea was pretty simple. It was to take venture capital and put it online. We were applying for some of the first licenses there with the UK regulator, and started making some of my first crypto investments at that time after speaking at that first conference. And because the crypto investments did so well, we kind of decided to dedicate Bank to the Future to supporting the Bitcoin market. And so around about 2015, we set out to build a global platform. We registered with our monetary authority in Cayman Islands, and we went through acquiring different licenses and various things. We have a US broker dealer and SEC registered ATS. So we were investing in some of the early companies like Bitstamp, Bitfinex, Shapeshift. We allowed, essentially, the early ones, VCs weren't investing in our industry much, so we were doing some of the seed investing and then allowing the equivalent of accredited investors to invest through our platform. And we later, VCs started investing, so we created a co-investment model where we would allow our syndicate to invest on the same terms as the VCs. And then suddenly, I guess like a couple of rewind or go forward a couple of years, around 2017, no company was willing to offer equity anymore. So we were fortunate enough to pick up some of the most valuable equity in the industry, and many of the investors through our platform before the huge boom market. But then tokens started disrupting equity, and no company was willing to offer equity anymore, and no investor wanted to invest in tokens because they wanted liquidity. And so really, we've just been dealing with this really fast changing market, the regulatory side, since 2010. I guess we were one of the first companies that was getting the UK regulators to look at investing online. And 3 years later, that led to the Jobs Act. So we've kind of been through the whole journey. And then, when ICOs came along, and it was no surprise to us because we where that would fit and whether it be treated as securities and stuff. So when we started doing token offerings on our platform, we've just from day one treated it as a security and always done it as a security, and knew that one day, the industry would probably need a lot of the regulations and compliance that we've been working on for so many years. And that kind of brings us where we are today.
Right. So a couple of things there. I know in the very beginning you were allowing people to invest in with like $10 increments, but you changed that model fairly quickly. And why did you do that?
So when we originally started the business, it was all around, the vision was to democratize investing, something that I guess ICOs actually did achieve in 2015, 16, 17 and beyond. But what we soon realized is that the only way to do that and still have a business was to be registered as a securities business in one jurisdiction. And then the only way of really compliantly doing that was you could only take on businesses in that jurisdiction and investors in that jurisdiction. So originally we had a UK equity crowdfunding platform allowing people to invest as little as £10 and pull that together. We soon started to realize that that was not scalable on a global scale because you had to simultaneously meet all the requirements of every regulator. And so once you actually start looking at global regulations, you soon start to realize that every securities law has certain carve out for certain types of investors. And regulators around the world have kind of done a couple of things. So the first is they created the distinction between a private market and a public market. A public market has much, much stricter requirements because investing in the public markets is for retail investors, people, mums and pups, pension funds, all sorts of other things that eventually gets exposure to very small investors that. And then you got the private markets, and the private markets don't need to do as many stringent things as what you would need to do an IPO because it's only marketed to people.
I'm sorry, you broke up there for a second. The private markets don't need what?
The private markets are not subject to the really, really strict requirements of going public, which is a lengthy process that costs lots of money and it is very restrictive to earlier stage companies. So you have the private markets, and the private markets have certain rules. And if you meet those rules, then you're allowed to market to what the regulators did is kind of the way they solved it is they said, well, just market to people that can afford to take the risk. And so the US has this definition of accredited investor, and each country around the world has a different definition. And so we started integrating with all the different securities acts around the world and acquiring various licenses, and just to be able to do it on a global scale, because when we started working with crypto businesses, it was so much more global. And just, there was people at the time, it was a very, very tiny niche, not many people wanted to invest in this industry. So if you were just restricted just to UK investors for UK companies, then you weren't going to get very many deals and you weren't going to get very many investors. So we soon started to realize that you have to, in order to go global, you have to kind of fit into the private investor rules as opposed to some of the public rules.
All right, cool. All right, so we're going to get into slightly more specific questions. So I remember when you guys were launching, and like you already said in your summary of Bank to the Future, you guys were, everyone that was investing in companies that you had listed on Bank to the Future, those people got some kind of equity from those companies. And you guys started long before all of these ICOs and tokens. And the token model and the ICO model has kind of gone around what you guys were trying to do within a regulatory structure and offered basically, like you said, I always considered it a security. Everyone, this is what bothers me. Everyone made fun of me for years for accusing Ethereum of being unlicensed, unregistered security. And the closer, my original view becomes to being right, the more people are now even more angry at me for being right to begin with, and telling them to be careful with ICOs, including Ethereum. But how did you guys, but you also mentioned that you offer ICOs through your platform. So how do you do that and treat them like a security at the same time?
So when we do token sales through our platform, we firstly comply with all securities laws in terms of how they're marketed and who they're marketed to. For example, if a US investor registers through our platform, then they have to go through all the 506C, 506C-D, and all these there's different types of offerings in the case of the US. And they all register through our US broker-dealer through the platform. Whereas if you're from a different jurisdiction, then you register in a slightly different way, and there's a different onboarding process. So that's that's how we deal with it through the platform. We do when we did equity, it was always, well, we still do equity. It was always syndicating into one special purpose vehicle, and then investors became investors in that special company. And then we could kind of combine the best of being an institutional investor with the benefit of having lots of investors and kind of having lots of people, but without having to mess up your cap table and all the problems that come from having that many. So the way we did it with tokens is we were always we would have a syndicate of people co-investing into what was normally called a pre-sale. And that would always be done via an investment contract. And then once the tokens were issued, they would have the ability to gain access to those tokens.
Okay. And all right. So do we want to, let's see, do we want to jump into the current regulatory situation now? So just this week, I mean, every single agency known to man has come out with their statements. Like I said, I have always been against all of these ICOs. I didn't like any of them. I know you've done interviews with Bitcoin Uncensored back in the day, and pretty much the same view on my end here. So what did you think about the recent SEC statements this week? And then we'll get to the FinCen after that. And how do you think it affects the space and your business in particular?
I guess we probably, full disclosure, we stand to benefit from this type of announcement because we've obviously got the structure and have been complying with the rules here. So it kind of means that while the market has got a lot bigger and every traditional finance house in the world is now standing and paying attention, what really is happening is the industry is going from its crypto roots to everyone having to go through a lot of these bankers, brokers, and financial institutions. And it's going to be a real, big adjustment process. Obviously, we've always played in the middle where, I came from investment banking. We've always done it the slow and registered way. But I also know what it means to be a Bitcoiner. So we kind of think we fit in the middle there and understand the best of both worlds, I guess. But the SEC has come out and pretty much said that the exchanges need to be very careful. Really, you can't really take the FinCen announcement and the SEC separately because they kind of relate to each other. The SEC has come out and said any exchanges trading securities need to register and be an ATS or work an exemption or be a national exchange. We took the route of doing everything through an ATS because we're looking at launching a securities token market in the future this year. And the interesting thing is the difference between, so you gave the Ethereum example. Well, there's different shades of so the industry kind of broke itself into utility tokens and security tokens. And this whole concept of a utility token.
I don't think it did. I don't think it did. On paper they did, but in reality they didn't.
Well, so yeah, on paper they did. So they were trying to, they were looking at US law, and US law has defined an investment contract. An investment contract is an obscure term because there's loads of ways of saying, well, I wasn't selling an investment. So over the years, the courts have kind of come to, different things by people trying to get around securities laws with lots of different stuff. And then the Howey Test has kind of been the thing that people have grabbed onto. And the Howey Test says that an investment contract is the giving of money under the management and control of others with the expectation of a return. Now, the reason that we never took utility tokens and were comfortable selling them purely as products is because we felt it always failed on the expectation of return. So if you go through the Bitcoin talk forums and the Telegram groups, everyone's like, well, you know, I want to get 10x, I want to get 100x, I want to get 1000x, when, you know, and all that type of stuff. So we believe that it always failed on the expectation of a return part. But there is definitely this different shades of gray, and I think the regulators do agree with this, because, you know, if you look at a decentralized blockchain where the token is used, so example, we use Ethereum, you know, while it, you know, obviously nothing's as decentralized as Bitcoin, but it was designed to try and be decentralized, but it used the credibility of its founder in order to try and leverage its reputation, because if you don't put a reputable person next to a token launch today, then everyone calls it a scam. So you need to leverage someone's reputation. And that's kind of what makes Bitcoin a commodity, I think. And sorry, I'm jumping around here, but the CFTC says Bitcoin's a commodity.
Well, I think what makes Bitcoin a commodity, it's not that Bitcoin is a commodity. It's that when you are offering leveraged trading of Bitcoin, you are using a commodity style contract. So while Bitcoin itself, I think it will be difficult to classify Bitcoin as a commodity, though it has features of a commodity. I think they're strictly talking about leveraged trading and margin trading of Bitcoin. If you're not utilizing margin and leveraged trading of Bitcoin, then I don't think CFTC has any jurisdiction over anything you do.
Yeah, absolutely. And so what's kind of come around now? So we gave that Ethereum example. You know, it's aiming to create some kind of decentralized network. There's a foundation, which is, you know, a strange structure. And so you have these questions of, well, does it have utility? Is it managed by somebody else? And are people using it, or are they investing in it for the expectation of return? And so the legal profession put together, you know, these exemptions and these things that ICOs need to do in order to tick some boxes. And then that kind of created this divide between utility and securities. And then some came along and said, you know, I'm not comfortable with that. We're just going to call it a security. And they put together some kind of structure like a SAFT or something like that, whereby it could be treated as a security. You know, this distinction, but this is where the SEC and FinCen have come out, and they've done something pretty clever, actually, because I never really understood exactly how they were going to distinguish between a security and a token that does have some kind of utility. But what they did do is FinCen said anyone doing an ICO. I'm
sorry, Simon. I might have some minor connectivity issues. I don't know if it's me or you.
It's probably me. I'm in the island.
I'm running the stream. Let me try something here. So I hope we don't get disconnected. I'm gonna switch to my cellular data instead of my Wi-Fi. And hopefully we don't get disconnected.
I don't think we got disconnected. It cut out for a second and we're back.
Yep, perfect. So I've switched to my cellular network because I happen to have a SIM card in my laptop. So hopefully, hopefully this will be better. So let's hope.
Okay.
Okay, they're also complaining about my video. I don't know, maybe I can turn off my video. I don't know. I mean, it wasn't a problem. I was on live podcast all morning. This wasn't the problem, so I don't know. Yeah, people are saying it's much better. Excellent. Okay, cool. So I'm sorry for interrupting, and go on.
Yeah, so we had this plethora of announcements where CFTC starts talking about futures trading being commodities when there's cryptocurrencies underlying. Then you had the SEC saying any exchanges that are listing securities must have an ATS or be a national exchange or working off an exemption. But then FinCen simultaneously said anyone doing an ICO needs to have a money transmitter license. Now, what this does is it's pretty smart. If you claim to be a utility token, then they're saying you have to have a money transmitter license. If you claim to be a securities token, then you have to sell it as a security, and the exchange that trades it needs to have an ATS or be able to exchange securities. Now, again, I got to put some disclaimers here. No one can use this as legal advice. I'm not a lawyer. I just happen to be paying, lots and lots of money to lawyers for many, many years, and hanging around with lawyers that are looking at these things. And our business is it. So, just don't take this as legal advice. But then what that kind of does is it squashes the people trying to do utility token, because they need to have a money transmitter license, and probably no ICO is going to bother trying to get a money transmitter license. And then if it's not got a money transmitter license, then it has to be a security. And if it's a security, it has to be in line with securities law. So the next thing people are going to do is then how does US gain jurisdiction over the people that have the tick box saying no US, no US? Well, the only way to genuinely meet the rules, so at Bank to the Future, we have to do KYC.
Yeah, you have to do full KYC.
And so the only way to genuinely prove that no US is to actually do KYC, even if you're doing an offshore thing, because if one US purchaser comes in for a utility token and you didn't have a money transmitter license, then you might be under the attack of FinCen at that point. So that makes the offshore ones have to do KYC if they want to prove and ensure that no US person purchased their token or invested in their security. And so what these regulators have done is they've all come together and said, utility token, money transmitter operator, security token, sell it as a security in line with our rules. And then there's they've created rules to allow retail investors called Reg A Plus and other things, or just do it as a Reg D offering to accredited investors, or do it as Reg S, where you don't take on any US investors. But if you're offshore, then if a US person purchases, now see the challenge here was always going to be, it was never, SEC enforcement, FinCen enforcement, CFTC regulatory enforcement was always a thing. But the risk is always actually the people that are purchasing the token. So when you invest in something and it doesn't go well, then everyone's really happy to say, oh, Tezos isn't a security, please let me invest. I'm a retail, I have every right to do what I want with my money.
When they think things are going to go well, the opposite, right? Yeah.
Then secondly, as soon as something goes bad, then they all sue and hire lawyers and say they sold me a security illegally. This was an unregistered securities offering. And then they all run to the government and say, bow down to the government's rules.
I exactly agree. And I've been saying that for years. By the way, speaking of the lawsuit against Tezos, the lawyer that is running that class action lawsuit was on my program a couple of days ago. I don't know if you caught that.
Oh, I'll definitely check that one out.
Yeah, check that one out. It was it's David Silver out of Florida. So he's the one running that. He also has lawsuits out against BitConnect and class action, and against Kraken and Coinbase. So he's been busy. He's been he's about to get a lot busier. Okay, wait, I have a couple of follow-ups on a bunch of things you said. So first of all, let me ask you this. And is Ethereum a utility token or a security? Your opinion.
I think it was sold as a security because it didn't exist and it was an investment in a future concept. But I think today it's got more utility-like properties than a security.
Okay, because to me it was sold as a utility token, but I knew it like they announced it as a utility token. You need Ethereum to run smart contracts, so it was sold on paper as a utility token. Now in my mind, it was always a security.
Yeah, sorry, that's the same. So what I was saying is they sold it as a utility. But I believe it began as a security if we had the benefit of experience now. But I think now it's less of a security and more utility.
Why do you think it's less of a security?
The products that are using Ethereum in order to launch the ICOs have much more security-like features. But the actual protocol and how people are using Ethereum, I believe, has more utility-like features.
Okay, but a lot of people are using Ethereum as an investment right now, and a lot of people are, trying to convince the world that Ethereum is actually a good currency to use, because Bitcoin is apparently too slow and too expensive.
Yeah, so I mean, but that's the same with Bitcoin, really. People are using Bitcoin as an investment, but that doesn't necessarily make it a security. People are using, land. They're using art.
I think what doesn't make Bitcoin a security is that there was no actual entity selling you the creation of Bitcoin, right? It was I think only because Bitcoin was created in a decentralized mining way. Like if only Ethereum started with a Genesis block the way Bitcoin did, I think it would be a lot more difficult to classify Ethereum as a security. I think in my opinion, what makes Ethereum a security is the fact that they created 72 million Ethereum and pre-sold it.
Yeah, I'd agree. The pre-sale is definitely one of those factors. And this is why Bitcoin is Bitcoin. It's just Bitcoin is like gold. It just exists. It's kind of gold came from the ground. Bitcoin came from the blockchain. There was no centralized entity or any founder, and that's why Bitcoin is Bitcoin, and that's why it's digital gold.
All right, so look, to be honest with you, the FinCen thing going after utility tokens was a bit of a surprise to me. I didn't see that coming because I figured that in order for FinCen to go after, the ICO space, they would have to first classify these things as money. They would have to first classify these things as a currency. But they said that they have jurisdiction over utility tokens, and I didn't see any kind of statement saying we have declared these utility tokens to be money for us to have jurisdiction on. I think this is a little weird that I didn't see coming.
Yeah, I didn't see it coming either, really. It is really, I think, the thing that they've cooked up for the lawyers all to contend and debate at the moment in order to try and get jurisdiction over these things and gain some control. Now,
in reality, right, like I know because I'm in this space and they know because they're not, probably they're not that stupid over at FinCen. They fully understand that these utility tokens are being treated as money. So in a way, FinCen is right, but I think it's governmental overreach to, even though you're kind of right, you have to first declare these tokens or prove that, hey, I know you say it's a utility token, but look, we have plenty of evidence that your utility token is being used as money outside of the utility of your platform. And I think that's the problem they run into. I think as long as your utility token is strictly inside your platform, it's not a big deal. Like, for example, kind of almost like airline miles, right? They have to be used inside the platform, and you're always going to get KYC'd because someone's name is on the airplane ticket. But with these utility tokens, you can use them for anonymous value transfer. And FinCen sees this, but I still don't understand how legally they can declare it without first making public statements informing all of these utility tokens creators that they're actually making money in that utility tokens and give them a heads up, at least a little. This should have been done a year ago, right? Like, in my opinion.
Well, regulations is always retrospective. Like, regulators don't forecast things. They wait for something to become so big, and they tend to be driven by investors and consumers complaining as well. So most the funny thing is about regulations, everyone complains about it, but it's always investor driven. It's always the investors that regulators get a slap on the wrist for saying, whenever something goes wrong, everyone says, well, why did the government allow this to happen? Why did the regulators let this happen? And then they've got to retrospectively kind of defend that. And that really was what the Senate hearing was. The Senate hearing was the CFTC, the SEC, making sure that they covered, we tried to stop this so that they got their back whenever this, stuff happens. But and also it was an amazing admission as well from if you listen to the Senate hearing, because they recognize that, there's a big problem. There's a big challenge in this industry right now, and that is that everyone under the age of 35 is just never going to invest in a traditional financial product, probably ever again. And that's just the cold, hard reality. They're not connected to the stock market. They're not interested in the bond market. They might just about be interested in gold, but that's kind of that thing that Peter Schiff pushes and people that age. And so they're all interested in crypto. They all have some kind of connection with crypto. The SEC chairman, the CFT's chairman were saying, my children, that all they talk about is crypto. They're just not interested in any of these products. So, investment banks and regulators, if 2017 continued, it was about to gobble up the entire financial market. People were going to do ICOs just to buy out public companies. Public companies were doing ICOs just to pump their share price, and this is where the SEC really started attacking first. The public companies that were launching blockchains and launching tokens in order to really push their share price. But if 2017 continued, if they didn't do something like this, it was the writing on the wall for traditional finance. This was about to create huge systemic risk in the traditional financial system. And tokens were going to consume every single financial product. Every asset class is still and will still be tokenized. It's all happening. Every financial institution, every broker dealer, everyone's trying to adjust to this. And it's just a question of, is this all going to go to the traditional broker dealer industry, or a fintech company is going to do this? And that's kind of what the debate is at the moment, I'd say.
Yeah, no, I completely agree with you on that. It was starting to get out of control. And I think the SEC really started to notice a lot of this stuff once traditional companies that, were probably going to go under anyway because they had no business and no revenue, they were now taking the chance saying, hey, all we got to do is change the name of our company to something blockchain, or send out a big press release that we are now, changing our business to blockchain, and the stock goes sky high. And I think that really put a fire under the SEC. The other issue is what I've been mentioning for a few months now, maybe way longer than that, is once a company that has absolutely no competency whatsoever decides to challenge a competent company, but all they have to do is ICO, and they have $100 million, while a competent company could only barely score $200,000 or $300,000 in VC investment while giving up a bunch of equity. You are now forcing every other company to go the route of the unregulated space because they have nothing to lose at that point. They're going to go out of business anyway.
I mean, that's something we definitely saw. I think it was, if we look at some of the things last year, how many, we used to get every single deal at Bank to the Future. We used to see every deal. We used to try and co-purchase every deal in our industry. And suddenly in 2017, we went from knowing every deal, doing due diligence on every deal, making sure we're invited to every deal, to getting about 30 applications a day on things that we had no idea on, how to analyze, because it was just going insane as every single industry and vertical was starting to enter this market. And so, you look at 2017, I think one of the largest, obviously you had the Coinbase deal, but one of the largest deals was something like blockchain.info, which was probably hustling VCs for about 6 months after years and years of growth and traction and becoming one of the major wallets in the industry, like it or not. But they got a lot of customers, and they were raising 50 million, and yet an idea like Bancor comes along and raises 150 million, with a white paper. And the established companies were getting really jealous, as it were, because they weren't willing to take the risk, because they had reputation and brand to lose. And yet the ones that were the earlier stage, the idea, the less credible and disclosures that they gave, the more likely they were to raise an incredible sum of money. And it just got completely skewed and completely backwards. And if I remember, we started Bank to the Future in 2010, if someone gave me 150 million in 2010, as an inexperienced entrepreneur, I wouldn't know how to spend that money. I wouldn't know what to do with that. You're not meant to raise that much money up front. There's a reason why it's incremental stages and rounds, is because you're meant to prove what you can do with $250,000 before you get in $1 million. You're meant to prove what you can do with $1 million.
It's also not just the money amount. It's also guidance and oversight from the person giving you the money, which is another reason that VCs exist as a function, because they have experience. So even you as an unexperienced entrepreneur, even if someone was to give you $100 million because they were generous and really believed in you, they would be there with their experience to help you. Otherwise, they would never give you that money. And that's a huge thing that people don't realize that doesn't exist with these ICOs, because they collected from the unqualified public that not only doesn't have any experience themselves in making sure you go through and properly run your new company, they also don't have the resources to go, let's say, after you. Like if like 3 people combine together to give you $100 million, they have plenty of resources to make sure that you can't just get away with it if you screw up.
Yeah, that's true. But also this isn't all negative, because I also believe that Bitcoin, I originally thought Bitcoin was going to be a big loser in this, because it was going to classify everything. Everyone was going to take all the ICOs, and it was going to create a lot of negativity. And then that was going to have big consequences on Bitcoin, because people didn't understand the difference between ICOs, tokens, and all this type of stuff. I personally believe that Bitcoin benefited from all of this, because I think Bitcoin's user case as a world reserve cryptocurrency for cryptocurrencies was a big user case. Now, while Ethereum took a lot of that market share, there's no doubt that a lot of this drove a lot of people, and the user case of world reserve cryptocurrency and trading pair for a lot of this stuff was definitely a big user case for Bitcoin.
I agree, but the jury is still out on how this is going to end, because I think the ICOs and the tokens are going to end very badly. Now, what kind of an effect that will have on Bitcoin in the future is still yet to be seen. I think that Bitcoin will get through it, and I think most of the damage will go to Ethereum and and all of the ICOs themselves. But the chapter on that hasn't closed yet, so let's. I'm still like reserving some reservations, because hey, what goes up unreasonably tends to come down unreasonably, and Ethereum has gone up more unreasonably than Bitcoin, but I think Bitcoin also went up a little bit unreasonably. But unlike Ethereum, though, I think there was legitimate reason for speculating on Bitcoin's future, because hey, you can trade Bitcoin through the CME in a regulated space. So the government did give Bitcoin a fair amount of legitimacy by allowing the futures market on Bitcoin but not any other alternative.
Well, the next chapter is quite clear to me, and I'm begrudging to second guess this industry, because if there's one thing I've learned from being here since 2011 is that every time I think I'm right, the market proves me completely wrong. But where it goes from here is ICOs got the entire world's attention to the power of what can be done with crypto and how much money there is. And then if it moves to securities tokens, it means that every broker and everyone's going to enter this industry. And now what that does is, I originally did not see the benefit of putting securities on the blockchain. I was originally, for ages at Bank to the Future, because obviously if we were funding a lot of stuff, everyone always said, well, why aren't you doing this on the blockchain? And I was like, well, because we've got to do KYC, we have to control who can have this. So we couldn't do that until the smart contract came, because then we could create whitelisted smart contracts where you can do KYC and you can control in kind of a semi-quasi model between these two things.
No, sorry. Hold on, I got to interrupt you here, because I think it's a little more complicated than that, right? It's not that, I always saw the potential of putting securities on the blockchain. What I disagreed with is putting securities on the Ethereum blockchain, because to me, that is an unstable technological mess. And while I don't have the technological capacity to explain that, I have privately spoken to many technical experts that do have the capacity to understand that. And they are pretty much in consensus that Ethereum is just not technologically sustainable. So while the idea itself is debatable of whether securities should or shouldn't be on the blockchain, the fact that they should not be on Ethereum is pretty clear by technical experts. And that's my biggest problem with this whole space at the moment.
Yeah, well, I think most people that have been around for a while would wish that there was a way of putting these securities on the Bitcoin blockchain, but that just isn't yet. Not that that's not going to come, because, you know, Lightning, SegWit, Rootstock, drive chains, all this stuff can come through. As you said, it's not been determined yet. But there's a huge network effect behind Ethereum now, and the only real way you can do any of this stuff is on Ethereum, because otherwise you have to put it on something that takes infinitely more risk until this innovation around Bitcoin comes along. But the next thing that I think comes along is, because of ICOs, because of the amount of liquidity that has entered this market, because of the boom in cryptocurrency, every single financial product is probably going to be traded against Bitcoin now, because as securities tokens become a thing, as more ATSs launch, as this market, grows. And one of the things that, and for us, when we were talking about launching our securities, a tokenized securities exchange, the main benefit of tokenizing was actually having Bitcoin as the reserve currency to be traded into and out to of these securities. And then when you have these giant, very, very large markets that will be traded into and out of Bitcoin, and probably they'll be done in Ethereum as well, and some kind of stable crypto backed by fiat, then you've taken the entire financial market, and really that all came because people became so wealthy from Bitcoin, and then became so wealthy from Ethereum, and then became so wealthy from ICOs, that now all the money, a lot of the money is in this market, and therefore they're looking to diversify across that. And as different products come along and securities tokens come along, you do have a gradual real uptake of, overhaul of the traditional financial sector. And that's where it probably goes next.
Right. But to me, that's not a diversification, right? To me, it's like, hey, I just made a bunch of money on this.com and I made additional money on that.com. So I want to diversify across other .coms. And then here comes the year 2000.
And that's exactly what created the Silicon Valley funding into, it was a bunch of VCs that made a load of money out of .coms that then started investing in their friends. And then Silicon Valley, became the .com Silicon Valley before, later.
All right, so we do have about 1,250 live viewers, and there is lots of chatter in my chat that I have to ask because I didn't even know. So did Bank to the Future ICO? And if you guys did, I would love to hear the details on that because I just don't know.
Yeah, so we did our own token offering. We sold it through the platform as an investment contract to accredited investors. And we're looking at launching our own securities token market later this year. And when we did the public sale, we did everything as KYC'd, AML, and restricted investing to the $1,000 that allowed you to actually purchase the membership to use on our platform.
Okay, so I'm just curious how it works. So the $1,000 was a minimum buy-in to the ICO token.
Correct, yeah.
And you marketed it as a security.
So we did it in two phases. We did the pre-sale, which was done as a security, and that was the vast majority of it. And then we sold a small amount of memberships after that.
Okay, so let's talk about the pre-sale part. So there was actually a piece of equity of Bank to the Future attached to the ICO token.
No, it was just sold as a security. So it was sold as an investment contract, and we now have equity, and we have our network effect that we're using our token for.
So people that were buying this your ICO, you did market. So people were buying it with the intention of profit, like following the Howey test.
Yep.
Okay. So what does that token buy them? So if it's not linked to a piece of the company, what are they like? Is there an underlying value to the token? How do you calculate the underlying value to the token?
Well, we don't really calculate the underlying value of the token, that the market will. But the utility that we created the token for was that we're launching a due diligence platform, and we wanted to create a rewards and membership token. So the investors that can invest through our platform that stake some of our tokens are able to actually get priority access to deals. And token was actually used as a rewards program for those that want to. So what the idea behind the token was to create and incentivize rewards for people that wanted to create due diligence, help voting on different deals that should be on the platform, and we created a rewards and membership mechanism for it.
So what was the initial price set for the token?
10 cents. And what we did, because we believed that a lot of the people were going to get in trouble because of discounts, we actually did the exact same price for everybody, and everybody paid the exact same price. So there was no bonuses, there was no discounts. Everyone, the VCs that invested, the members on Bank to the Future that invested, and the people that actually purchased tokens all paid the same price.
Okay, so every token was sold for, so the entire pre-sale was 10 cents per token. How many tokens were sold?
330 million. So at 10 cents, that was 33 million.
Okay, so those were all the pre-sale tokens. Okay, and those tokens were an ERC20 on Ethereum.
The only way we could do a token is an ERC20 token on Ethereum at the moment.
So I agree with you. It was the only thing you could have launched at the time, since this functionality doesn't exist on Bitcoin, and anything else is even more insecure than Ethereum is. So I agree with that statement. What are, and I asked this question to a lot of other people. So what will you do if Ethereum forks again between, let's say, proof of stake or proof of work?
My hope is that Rootstock comes online, and we can give everyone the ability to do a one-to-one swap for our ERC20 token and our Rootstock token. But essentially, there's been models. So, for example, Storage, they were originally on Omni and then switched to Ethereum, and they allowed everyone that had their Omni token to switch to their ERC20 token. And you can just do a one-to-one swap for that. And there's dual markets listed. So if there was a disaster in Ethereum, then you can simply create a mechanism whereby people can swap their tokens for something else.
Okay, so another question. So is your token now openly traded on exchanges?
It's not at the moment, but we can't stop exchanges from listing it.
Okay, but no exchange has listed your token yet?
Not yet. Well, we just stopped the ICO. So.
Oh, so when did the pre-sale finish?
And
what makes it a pre-sale versus a sale? Are you gonna have another sale?
So the pre-sale was all done through Bank to the Future as an investment contract, and then the public sale, what we call the public sale, was we allow people to purchase memberships of $1,000, and so that was the only amount you could purchase. And the pre-sale was done as an investment contract through the platform, and then the public sale was anyone that passed the KYC, that did the whitelisting, and went through the whole process could purchase tokens.
And did the public sale come? Did you create additional tokens for the public sale, or the public sale was from the pre-sale people?
So the exact amount of tokens was all created up front, and then 300 million of them were sold in the pre-sale, and 30 million were sold in the public sale.
Okay, so and so what? I'm sorry. So maybe I've had a long day doing a lot of podcasts. So what was the difference? I mean, both groups had the KYC, right? So what
Yeah,
was
everyone had to do the KYC, but the people that invested in
what was the difference between the two groups? I'm still confused on that.
the difference is that they invested as an investment contract through banktothefuture.com, and the people that invested, and they could have a different amount. So they were capped at 10 grand, and we just had different amounts. So we had the VCs that were capped at $1 million, and then the investors through Bank to the Future were capped at 10 grand. And then for the actual public sale, you could only purchase a membership of $1,000 minimum maximum.
Oh, okay, so we're just 1,000, and since you're KYCing every purchaser, like you got to get like your mom or your sister if you want 3,000. Like you can't do more than 1,000 per person.
And you had to be whitelisted, so you had to whitelist the address in advance, and yeah.
Right, to make sure that they're not going to the same place, so they literally have different people. Okay, gotcha. Okay, so now at least I understand the differences. And when did all of this conclude?
It was when I was at the Anarcho Poco conference.
Oh,
so I think that was 16th of Feb.
Okay, so it's only been 2 weeks. Okay, and are you planning to create more tokens?
No, all the tokens are issued, and yeah, the distribution schedule was all published up front.
So distribution schedule. So the more tokens will be created.
They've already been created, but we have a whole rewards program and a pool of tokens that can only be used for rewards people, as explained in the distribution, for performing all the due diligence and stuff. So all the tokens have been created.
Well, okay, so all the tokens have been created, but have all the tokens already been sold to investors, or there's another giant batch of tokens that can still be purchased?
No, there's no to sell. There's none to sell to investors. They'd have to purchase on the secondary market if they wanted to.
Okay, so all the tokens that will ever exist are already in the hands, but there's no secondary market yet.
Yeah.
Okay, so my question to you is, and I'm curious how your lawyers advised you. Once I understand that the initial pre-sale and token sale goes to the qualified investors, but once it goes to the secondary market, and that secondary market could be tomorrow or it could be a year from now, and for the time being, while you really, really want every single exchange that could possibly list your token to fully KYC every single person trading on that exchange. But at the moment, that doesn't happen. So how are you absolutely sure that there's no laws that can come back and bite you in the ass if your token starts trading anonymously on these secondary exchanges by 12-year-olds?
Well, most of the exchanges and all the exchanges like we're shareholders in, they do KYC. I know there aren't ones and there are decentralized ones. But at that point, what people do with their tokens is up to people what they do with their tokens. We can't control it at that point. Whether the exchange has to have a securities license in order to do these or not is whether the liquidity provider to actually do that. But people are able to utilize these tokens and they're able to send them to each other. And if an exchange lists them, then they need to make sure that they're complying with whatever they need to comply with. And that's not something that can be controlled.
All right. Okay, so I have an idea what or what it is. But if someone is to use the token within your platform, they would also have to be KYC'd for whatever it is that token is good for.
So we've got two types of things. We've got someone that is an actual investor on our platform and they get membership. They'd have to be, if they're in the US, they'd have to be an accredited investor. If they're in their local jurisdiction, there'll be a different definition and different type of people that qualifies. And so in order to use the membership, you'd have to do that. But in order to participate in due diligence and participate in our process of you stake some tokens and you perform due diligence, you help us vote on what deals should be on our platform, then you can receive tokens, and anyone can do that because you're restricted from actually investing, but you can participate in that process.
All right. I got you. So I guess we have to wait and see for the secondary market and then see what's going on with that. Anything else you wanted to talk about, Simon, before we head out? It's been about an hour. These things usually are about an hour.
No, I guess that's it. I mean, I guess this ATS stuff, I think, is a new interesting development. We're looking at launching a securities token market and everything. The challenge is the multi-jurisdictional thing. There's different rules in US, there's different rules in different thing, and that's been something we've been working on since 2010. So yeah, I guess it's a pretty interesting time, and we'll see where this goes next time.
All right, pretty cool. All right, guys, so that was Simon Dixon of Bank to the Future, and you think this regulation would be good for your business?
Well, we're kind of invested either way. So if this ended up fully decentralized and no regulations, I highly doubt that will ever happen. But if it does, then we're kind of hedged against that. We're invested in the industry. If it turns out that our industry needs someone that has the right mix between being compliance driven at the same time as really trying to maintain some of what this industry is meant to do, then we feel we've got that, and so that drives some more business to our industry. We're kind of indifferent here. We've always been about supporting the Bitcoin industry.
All right, guys. Thanks for tuning in. We are still closing out with about 1,250 viewers. Thank you for watching. This was On the Record with your host, Tone Vays, and my guest, Simon Dixon. And catch me later tonight, where I'll be doing my traditional Bitcoin trading analysis. And Simon, tell people where they can find you.
So on my bottom third, I got my Twitter account. That's the best place to get me.
All right. So Simon Dixon tweet, and I will have all of the links to everything you saw in screen share in the video description. All right. Thanks, guys. Thank you for watching.